Welcome back to Day Trading Concepts YouTube channel, traders. In this rather short lesson, I'll discuss a rather common recently market environment for intraday trading the index futures, the volatile directional market. I'll make a number of technical observations that I hope you find useful and insightful, but more importantly, I'll attempt to give you a framework within which you could consider your process and the way that you take your tactical decisions as you're reviewing your work and as you're trying to improve. I will finish by offering you one of my favorite approaches to finding the high value opportunities within this market environment. All right, so we're talking about volatile directional markets. We're talking about sequences of higher lows and higher highs, or lower highs and lower lows if the market was moving lower, and you are attempting to identify how the best risk-reward opportunities will manifest themselves on the chart. The problem or the challenge with volatile directional markets is that the extra volatility the market manifests is not only part of the reward, but unfortunately the risk as well. It is fundamentally a problem of scale, which is the size of the moves and retracements or consolidations that you are defining as you're looking for these high value zones to buy or sell. We try to solve this problem by gaining insight into the market's rhythm. And of course, another important consideration here is posture, or the way that you're formulating the entry and management decisions for your opportunities. Within strong directional markets, we get a sizable wave, which is usually a sequence of run and retracements or consolidations, and that overall defines a rather extended macro run or move. And of course, there's also the counterdirectional episode or portion of this behavior, which tends to be, because of the extra volatility, of consistently more significant size. Since we would favor the long side within a progression of higher lows and higher highs, then the task is fundamentally to describe as best as possible the counter-directional episodes and decide on what scale or with what rhythm we're going to trade these. For some of you, this approach or solution is rather simple. You're looking to gain insight into the rhythm of the actual run and try to transfer this insight into the counter-directional episode so that you can find where you are buying within the discount portion of this progression. Many of you probably employ fib retracements, and it's as simple as pulling a fib 2 from the bottom to the top of the run and then looking for these high value areas to buy. These are classic fib levels. You can see the 31.2, 50% pullback, and of course the 61.8. And while any one of these might be useful, you can see that in this particular case, the market goes through them in the counter-directional episodes, in effect, putting you into much less favorable risk-reward situations if you decide to play defense and take that risk following a rather early entry on the way against your position. Of course, another way to correlate the opportunity to the right with what's already offered to the left is to look for important areas of interest from the left side of the chart. In this case, maybe looking for previous areas of resistance and looking to use them as support to the right as you're trying to define at what point the discount episode or the counter-directional move will actually tend to stabilize and price will go into the next wave, which spells ground floor entry and the potential for significant profits. Of course, a combination of ways to adapt and define the bottom of these counter-directional episodes would be ideal and would likely increase your edge of being correct with the approach you pick for taking your opportunities. One of my favorite observations in these markets, other than the ones that I already mentioned, is to track the general size of these counter-directional episodes. Top to bottom, you'll see that they will often be of similar size here, very close to the top, somewhat close to the bottom. You can see that this one as well is roughly of the same size. Now, it is fundamentally a problem of scale to work with volatile directional markets. As the market expands significant amounts of energy within the directional episodes, it is reasonable to expect that it'll either burn extra amount of time, which manifests on the chart as consolidations or horizontal moments for price, or it's going to have to burn extra space as it pulls more than usual on the way back before it is ready to continue. This happens because the market needs to recover its energy. It's the dynamics of supply and demand, buying and selling, that allows positions to get closed, participants to go through the cycle of disappointment or fear, and then again being enticed by greed or in general for looking for the next opportunity. Now, if we examine the dynamics here of the directional episode and then the counter-directional episode with the potential for continuation into the second wave or the second directional move, fundamentally you are trying to participate either on the left side of that turning point, of course ideally as close to the bottom of the counter-directional or discount episode as possible, or of course you might be trying to trade on the right side. It's important to understand that regardless of what your preferred approach is, no one tactical decision or strategy is ideal. It's just a trade-off of different types of risk. If you're trying to call the market's final point in the counter-directional episode before you actually have seen that pivot for a fact, then what you're doing is betting fundamentally on as good of a price as possible, leaving an order waiting, and deciding to see whether your chosen price or pivotal point will be close enough to the bottom within your allotted risk, so that you can hopefully gain enough reward for the risk that you're taking. Alternatively, if you rely a little more on the market's rhythm, you could be looking for certain particular observations that potentially spell at what point the market might actually be creating that pivotal point and turning back up. The more of these confirmations or little observations in rhythm you're trying to see before you participate, then the more confirmation you're looking for, and fundamentally the risk that you're taking is that you will either miss the opportunity or you will have to pay for that extra information by getting a less favorable price further away from that pivotal point. So as you review your work, make sure that you understand whether you tend to or prefer to participate early by picking the general pivotal point in advance, or whether you're looking for clues in price in the form of analyzing the market's rhythm before you define the entry for your opportunity. Posture is also an important aspect of your adaptation, since risk is the animating principle of trading. If, let's say, for example, you're willing to take that much risk in terms of vertical movement in price before you decide that you're wrong and you will take the stop, fundamentally the game you're playing on the left side of the pivot is one of deciding on what is a good enough price where you will take the risk and rely on the size of your stop to accommodate whether it's the extra noise that the price offers or a certain amount of counter-directional movement which works against your position. Make sure that regardless of whether you tend to prefer this approach or you prefer to trade on the right side of the pivot, once you have seen a certain confirmation, make sure that you like the absolute price at which your stop is resting. If this is your entry, then this would be where your stop is resting, so that once you take the risk, you are willing to see the market work against you, but still give you the confidence to hold the initial course of the trade and commit to the risk, so that you don't tend to overmanage or micromanage your opportunities, because every twitch and every bar, once you enter a position, tends to be broken to the prism of fear, and may in general cause the developing trader to overreact, change the initial plan, or introduce potential information from a different scale than the one on which he or she defined the opportunity to change the trading plan. One of my favorite ways to adapt to these behaviors is based on the idea of analyzing the market's counter-directional episode. Now, I tend to analyze all portions of the movement to the left, including the directional and the counter-directional episode, with the most focus being devoted to defining the pivotal points of the counter-directional episodes. In this case, since the market is offering us here in this chart a sequence of higher lows and higher highs, I'm of course interested in defining the bottoms that the market leaves behind on its way higher. And of course, as I'm analyzing this rhythm, I make certain observations that I try to consider as precedents for a potential repetition, or at least some form of rhyming that the market offers me later on, so that I can trade this precedent repetition pattern on the way into the next wave, and hopefully in this case into higher highs. If we analyze here the initial bottom that formed within the pre-market, you will see that the market dipped after at least a few waves here of counter-directional movement. But more importantly, on the right side of this pivot, you can see that there is a significant buildup on a gentle slope, or a sequence of a few minor higher lows and higher highs before we actually see price flower extend vertically and offer us follow through into higher prices. Further observations for potentially secondary trades would be that the initial shallow pullbacks and slowdown within the steep directional movement tend to hold in a classic manner and offer multiple stair-stepping overextensions into yet higher and higher prices. So the primary opportunity would be found somewhere here in the bottom after the initial or close to the secondary shoulder on slightly higher lows. In general, I'm looking for these gradual scale up in these micro pivots, which give me confidence that I have likely already seen the bottom and I'm on the right side of the turning point where my positioning would be ideal. Around the opening bell, you can see that as the market have experienced a rather significant counter-directional episode after an initial pullback, the attempted follow-through is met by a slightly higher low, and then the market starts to edge back in the direction of the original strength. And of course, as I see another pivot, I would be tempted to trade this opportunity relatively close to the bottom based on the previous precedent, ideally with a stop that resides just below the distal edge here, or the lowest point of this pattern. This is what would have worked out best here, and this is what is reasonable risk to take based on the potential reward available within a significant directional move. Of course, the initial target would be the test of these tops, but very likely that the market is fluctuating back and forth around 4,300 here. It's likely that it might eventually, because of the high low, look for a new high as well. So consider how much risk would keep you safe behind your pattern. Consider also the general geometry that the market is leaving behind, and trade this as a simple precedent into repetition pattern, which allows you some confidence as to where the opportunity should work out from. As we gain the next wave, another important observation is that the market tends to round over or decelerate in the latter stages of the directional movement, and then offer us the counter-directional episode. This deceleration gives you a very clear visual feel for at what point the market has found its pinnacle, and usually if it finds a significant shoulder on the right side of that pinnacle, you know that you have already rolled over the top and you're in the counter-directional episode, which is a decent timing tool for when you are starting to either measure for the size of the counter-directional move, or maybe even get yourself out of a long opportunity that you have held from a certain point previously the way to that point. We observe the same very clear deceleration here, and again, as the market starts to offer shoulders on the right side, it is likely that we're now beyond the highest point on the curve. Therefore, if we're still managing along, we have to look for the exit promptly, or if you weren't in a position so far, you might consider either a very conservative counter-directional trade, or you would probably decide to stay out of relatively recent developments here for further continuation trades. A common mistake that I observed in developing traders is that they don't account for the scale and the size of these directional moves. And once the market offers rather minor counter-directional moves, they tend to enter too early, fumbling the rhythm for the opportunity. Remember, there's a certain amount of symmetry in the market, so the larger the counter-directional episodes, the more likely is that you're either going to see a rather sizable consolidation. Consolidation suggests that you will see where the market offers the counter-directional boundary and where likely some amount of buying is happening. So at the very least, you don't want to rush into the opportunity, because chances are you're going to have enough time, if it's an extended sideways episode, to define exactly where the buyers are stepping up and get a good price. And of course, the question of rhythm also suggests that you should analyze the scale on which it's likely you will see that counter-directional episode. So if you tend to maybe enter too early, let's say that you saw this initial counter-directional move, you saw that the market didn't want to continue, but then as it was trying to go higher, you decided to trade these potential high lows. Of course, you might consider that there's a precedent for that behavior, but if it wasn't very crystal clear, or if the market proves you wrong as it breaks that distal edge here, you could also check with the general size of the counter-directional episode, which is another measurement or scale observation to better define what is the next potential zone of interest for you as a buyer. Many times you will observe a secondary wave if the market fails to continue. You can see that from this double bottom, the market failed to continue higher. Somewhat similar an event happened here. A number of buyers stepped up. The market tried to continue by breaking that consolidation into higher prices, but then got soundly rejected, making a new low, which suggests that there will likely be a secondary wave of correction. So if this is the initial consolidation, there's your wave of correction. So the market is burning both space and price counter-directionally in an effort to recover its energy. Here, the dynamics were slightly different. The market had the first wave of the pullback, consolidated to form a bit of a middle, and then had a second wave of the pullback, creating a classic two-wave pullback. There is one of these after the second wave, and after the market had a reasonable size or similar size counter-directional episode. This is lining up with the fib levels here at 50 and 61.8%, and of course that is a previous area of resistance that now might become an area of support. So as soon as you observe the market showing you a familiar pattern, you could be looking to position, again, relatively close to the bottom, and look for a certain extension. Now, this is an interesting precedent because the market definitely would have put your conviction and ability to stay disciplined to the test. You can see that there were at least a couple very strong drives to the bottom, which, however, never compromised the very low behind which a certain amount, your stop would be best positioned. And even though the market took quite a bit of time here and didn't necessarily develop right away. This, by the way, is important information. Previously, you saw that following the pivotal point, the initial shallow pullback trades promptly led you into an overextension. Here, the market didn't see these vertical moves, see any amount of cascading or follow through, which is likely going to suggest that as you're seeing an anomaly to the pattern, you should likely adjust your posture and either take a smaller profit or decide for another contingency to manage your risk. In this case, you got a secondary attempt from price to reach these higher levels, but once again, the initial shallow pullback opportunity did not see any follow-through. Usually after the secondary failure of a certain expected scenario for development, I tend to aggressively manage out of the opportunity. So you take a graceful before the market actually comes down and challenges your stop below these levels. And of course, that ultimate failure to continue a couple of times with the strong movement and a definite new low in the opposite direction creates opportunities on the way down. Let's consider the same potential approach in defining the pivotal point in the counter-directional episodes into the previous session from Tuesday, where we had the same approach would have worked out very well. So we had a pattern, but the pattern itself was of rather different technical quality than the one we saw here on Wednesday. If we go back here to the pre-market, you will see that the strong directional wave, which the market faded, had a certain quality here. If we observe how the buyers took control of this downward progression, you can see that initially there were a few thicknesses here or minor structure where the buyers were accumulating. However, that initial support didn't offer us the follow through into new highs. Instead, there was a pivot component or a fall ball here as the market broke to the downside but failed to continue. Then it managed to recover back above this level of initial interest. You can see it on the right side of this level of interest. Again, the buyer stepped in, and only from the secondary accumulation or from the shoulders on the right side of the pivot did we see the follow through. If we analyze that pattern and we're aware of its details, and if we're focusing on looking for a potential precedent like that, once the market falls into the counter-directional episode, you will see that at a certain point here, we will already be aware the market is no longer looking to keep extending to the upside, but is in a rather strong counter-directional episodes. The latest support that the market left on the way up was built on the buying interest established at these levels. As the market breaks these levels and goes below them, we observe a certain failure and the market starts to pivot and find prices back above this layer. So you have a choice. You could try to trade shortly on the right side of this event, ideally somewhere here or here where you have seen a certain separation back above this level. Or, of course, you could see some confirmation in the form of the market consistently heading higher, because on the right edge of the chart here, you might still carry a certain amount of doubt that there might be sellers still controlling this market. However, once you see the confirmation of higher prices, you might wait for the market to return to the scene of the crime and again look to pick it up for what is now again shoulder on the right side of this pivot component following an initial establishment of precedents to the left. So the pattern is one of left shoulders, pivot component, right shoulders, playing for a new high. In this case, you can see that the market definitely affords that. So even if you took a certain amount of risk here to stay below this pivot component, you definitely would have had the multiples of your risk to reward you for this premise. You can see the same pattern repeat a little bit later. There's a certain amount of buying interest establishing in this space. The market challenges this interest and likely cleans the book out of the weaker positions from these prices. But since it sees no further follow through here into lower prices, it recovers back up. And again, once you get clearance on the right side, you could be picking up this opportunity, leaving your stop as low as reasonably possible for your allotted amount of risk, and seeing eventually price move into new highs. Here there was once again a return to the scene of the crime and maybe even a secondary repeat of the same pattern. You can see shoulders on the left side, pivot component. In this case, there were no shoulders on the right side, but similar to the observation of the actual directional episode that I did on the other session, here we observed the initial shallow pullback opportunities did offer still reasonable placement for the extension, and the market here on the left side displaying the exact same pattern to the exact same prices as it was led into, again, new highs. So in this case, we return to the scene of the crime one more time, and the market again had a pivot component here as it took out these established positions. There's the pivot component. There's again positions being established or defended on the left side of the event, and then on the right side again, no shoulders here, but rather initial shallow pullbacks, which would have led you to steep directional movement and ultimately higher prices. This is my favorite way to define the counter-directional episode, analyze the rhythm, and then look for a repetition of this precedent as I try to take advantage of the highest probability and best reward versus risk opportunities within the session. Hopefully, this perspective is useful as you analyze your work and try to improve your approach and your bottom line. Let me know in the comment section below if you have any questions. This is Nikolai with Day Trading Concepts, and I'll catch you in the next lesson.